One of my investment portfolios has returned over 40% as of the time I'm recording this video. I'll put a screenshot somewhere here so you can see for yourself. The most intriguing part of this portfolio is that I only invested in 2 ETFs. As a matter of fact, I stopped investing in one of the ETFs and focused on just one ETF for the past couple of months. ETFs, exchange traded funds, is one of the easiest and safest way to begin investing in the financial market. But here is the twist. A lot of people still miss out on important details about ETFs, and most times they buy these investments based off online recommendations or what their friends told them to do. So in today's video, I'm breaking down the essentials of ETFs, what they are, how they work, and more importantly, what you should know before you invest your hard-earned money into them. Just the real stuff I wish someone had told me when I first started investing. So whether you're a curious beginner or just want to feel a little more confident in your investing journey, you're in the right place. Click the like button and make sure you watch till the end, as I will share a simple shortcut to find the details of any and every ETF that you want to invest in. So what is an ETF? An ETF, or exchange traded fund, is a type of investment fund that holds a collection of assets. So we're talking stocks, bonds, or commodities, and it's traded on the stock exchange just like your regular stock, right? It allows investors to gain exposure to a broad range of investments through a single purchase. So it instantly offers diversification, liquidity, and it's typically lower fees. If you're a beginner, just think of an ETF like a snack variety pack that you buy at the store. So instead of buying one big bag of Doritos, you're buying a box that has Doritos, it has Cheetos, it has Lay's, and maybe a few other chips too, all in one box. That way, if you get tired of one, or if one flavor isn't that great, the others are still there to enjoy. You sort of spread out the risk of getting stuck with just one snack. Same way in the world of investing, that snack box is an ETF. So instead of buying one stock like maybe Apple, you buy a small piece of a bunch of different companies all at once. So maybe Apple, Google, Amazon, Tesla, and the rest of them all together in one investment. And here's the cool part. You can buy or sell that ETF anytime during the day, just like a regular stock. An ETF gives you instant variety, so your money is not all riding on one company. It's often cheaper and simpler than trying to buy all those companies one by one. So a real example, or a real life example to drive home the point. Let's say you think tech is the future, but you don't want to bet everything on just Apple. You could buy a tech ETF, like one that holds shares of Apple, Microsoft, Nvidia, and a bunch of other big tech companies. Now, if one of them has had a bad week, your money isn't totally sunk out, and the others kind of help you balance it out. But before you click the buy button, what are some things that you need to know about ETFs? The first is the holdings or underlying assets of the ETF. You need to ask this important question: what is inside this ETF that I am about to buy? Like I explained earlier, an ETF is basically a basket of investments, but every basket is different. They're not built equally. Some hold tech stocks, some hold energy companies, some are full of government bonds, some even hold gold. Yes, gold, like literal gold. If you don't know what's in the basket, you're basically just buying blind. I would share an example. Let's say you find this ETF called XLK. Sounds cool, right? You Google it and you see it's technology ETF. So you think, nice, I love tech. But if you look inside it, you'll see it's heavily weighted toward just 3 companies: Apple, Microsoft, and Nvidia. So even if it says that it's a tech ETF, you're really just getting a big dose of those 3 companies. That's not as diversified as you might think. On the flip side, take something like VTI that holds over 3,000 US stocks from all kinds of sectors. That's a whole different vibe. So yes, both are ETFs, but they behave very differently. What's the big deal, you might ask? If you didn't check what XLK holds and tech stocks tank, or Apple had a bad quarter, your whole investment could take a hit. But if you had something more diversified like VTI, A dip in one company wouldn't hurt as much because the risk is spread out. That's why knowing what is inside the ETF helps you understand the risk, the potential returns, and whether it actually fits your goals. So next time you look at an ETF, do this one thing. Google the ETF plus holdings. For example, VTI holdings or XLK holdings. You'll find a breakdown of what's inside the ETF, the top stocks that make up that ETF, how much of that fund or the percentage they take up, and what sectors it is focused on. It takes like 30 seconds and it gives you a ton of clarity. Next, you should always check who is managing the ETF, known as the issuer or the asset manager, because they play a big role in how reliable, efficient, and cost-effective the ETF is. The issuer is responsible for building and maintaining the ETF, which includes selecting the investment, keeping the fund in line with its goal, like if it's tracking an index. They're involved in handling the operations and making sure that that ETF complies with regulations, right? Reputable issuers like Vanguard, iShares, which is BlackRock, or State Street have huge experience. They have very strong infrastructure and lower operating costs, which often translates to lower fees for you, and then tighter tracking to the index and better liquidity. You can basically buy or sell more easily. A good example is the Vanguard's VOO that is managed with such precision that it rarely deviates from the index, and it charges 0.03% in fees. So now imagine a small or unknown issuer. They might charge higher fees, they probably have poor index tracking, or worse, they could shut down the ETF due to low demand. And if this were to happen, your investment gets liquidated and you could be stuck selling at a bad time or dealing with an unexpected tax bill. So in short, the issuer matters so much because it affects your costs, it affects your performance, and ultimately affects your peace of mind. So stick with names that you trust. The third thing you want to know before you buy an ETF is the ETF's performance and tracking accuracy. It's important to check how well the ETF tracks the index that it's supposed to track. And this is called tracking, or popularly known as tracking accuracy. Just because an ETF says that it follows something like the S&P 500 doesn't mean it does it perfectly. Some ETFs lag behind due to high fees, some lag behind due to poor management, or even inefficient trading, which creates what's called a tracking error. A good example here is VOO and SPY. They are owned by two different companies, but they both aim to track the S&P 500. Interestingly, VOO generally has slightly lower fees, which helps it stick closer to the index that is supposed to track over time. The small difference between their expense ratios can really add up over the years of investing. If you buy an ETF with poor tracking, you might earn less than the index, even if the market does well. And that underperformance eats well into your own returns for absolutely no good reason. So yes, always check the ETF's historical performance versus its benchmark, because you're not just buying the label, you're buying results. Next is the cost and fees of the ETF. The expense ratio is the annual fee that an ETF charges to manage your money. Usually this is shown as a small percentage of your investments. Expense ratio goes by different names. It could be called management fee, total annual fund operating fees, or total expense ratio TER. It all depends on the investment platform or the country that you live in. So don't get confused. All these terms, they pretty much mean the same thing. This fee is automatically taken out of the fund's returns. So you won't get a bill saying you have to pay this. It's automatically taken out of your account and it eats into your profits. So while 0.5% might not sound like much, but trust me, over time it adds up, especially with compound growth. Let's say you invest $100,000. If your ETF charges 0.5%, you would pay $500 as compared to an ETF that charges just 0.03%. That's $500 against $30 for 1 year. So between both amounts, that's money you could have kept as part of your return. So before you buy an ETF, always check the expense ratio, because high fees, I tell you, it can quietly drag you down your returns, especially if you're investing for the long haul. Lower fees are usually better, unless a higher fee ETF gives you something that is truly unique in terms of returns. The next thing you want to be aware of before you buy your next ETF is the ETF's dividend policy. Basically what it does with the income it earns from the stocks or bonds that the ETF holds. So some ETFs pay out dividends to you as cash. They are called distributing ETFs, while others automatically reinvest those dividends back into the fund, and these ones are called accumulating ETFs. This matters because it affects your cash flow, and you know that automatically affects your taxes and then compounding. So for example, if you're looking for steady income, a distributing ETF like Vanguard High Dividend Yield ETF, VYM, might suit you. But if you're focused on growth, an accumulating ETF could help your investment grow faster over time. Also, don't fall into this common trap of chasing high dividend yields. A high dividend yield might look attractive, let's say 6 to 8%, but it can sometimes be a red flag. The fund may just be holding risky or declining stocks just so that they can maintain that consistent payout. And remember, dividends are not free money. They are taxed. They come out of the ETF's value. So always check the dividend yield, how it's paid, whether it actually fits your own personal goals and not just the desire for a passive income. The last point you need to be familiar with before investing is the geographic and currency exposure of the ETF. It's really crucial for you to understand the currency risk when buying international ETFs. If a fund holds assets denominated in a foreign currency or in foreign currencies, there are two key factors that actually affect your returns. The first is the performance of the underlying foreign assets that the ETF holds. The second thing is the fluctuation in currency exchange rates. So for example, if the US dollar strengthens sharply against the euro, then a European stock ETF might deliver strong local returns, right? But when you convert that, they're going to convert to fewer dollars than expected once you bring those profits home. So a key consideration when it comes to exchange rates is what we call hedging. Some international ETFs are currency hedged, meaning they attempt to neutralize or reduce the impact of exchange rate savings on your returns. So a good example is the iShares currency hedged MSCI Europe Australia Far East ETF with ticker symbol HEFA. That's a long name. This ETF seeks exposure to developed international stocks while mitigating currency fluctuations versus the US dollar. So if you buy a non-hedged fund, you're implicitly making a bet on the foreign currencies relative to your home currency. If that bet goes against you, it can eat into your returns, or in some cases, it completely wipes off the gains that you have made from the stocks themselves. One of the common traps that I see when I talk to people about ETFs is that many world or global ETFs might seem diversified, but oftentimes they are heavily tilted towards the US companies and the US dollar. So a good example of this is iShares Global Tech ETF IXN. This is marketed as global, but it roughly has 80% US stock exposure. That means that even though you think that you're investing in an international ETF, you still have exposure, or you're largely exposed to the US currency and then the US market risk. So you might think it's diversified, or you might think you're diversified, but you're not. So what are the practical takeaways here? Always check whether the international ETF is hedged or unhedged. If it is hedged, you reduce currency risk, but you may pay slightly higher fees or give up potential upside if the foreign currency strengthens. Look beyond the world or global label. Verify geographic plus currency exposure. How much is truly non-US? How much currency risk is embedded? If your goal is true international, and by that I mean non-US diversification, you can consider alternatives such as the Vanguard Total International Stock ETF VXUS, which covers developed and emerging markets excluding the US population. Or you could try VEU, Vanguard FTSE All World ex-US ETF, another broad ex-US option. If you're worried about currency risk, a hedged version like HEFA that I mentioned earlier in the video best fits your portfolio. So by doing this homework ahead of time, you would avoid the mistake of thinking you're diversified when you're still exposed to one currency, and you better align the ETF structure, be it hedged or unhedged, with your risk tolerance and outlook. Now here's the pro tip for you guys. All of the information that you need regarding any and every ETF of your choice is free and can be found online, specifically on the broker's website or the ETF provider's website. If you wanted to invest in, say, QQQ for example, go to Invesco's website and review the fact sheets or prospectus for QQQ. All the information that you need before you make your decision can be found there. If you would like to see more ETF videos like this, or you want to get a glimpse of the exact ETFs that I hold in my investment portfolio that gives me juicy returns, just comment ETF below so I know the type of content to bring your way. Thank you for watching, and don't forget to click the like button. Also subscribe to the channel. See you in the next one. Bye.